What if I told you there's a company that gets paid every single time you buy something anywhere in the world? Not just in one country, not just in one currency, everywhere. This is not a bank. It doesn't lend money. It doesn't take on credit risk. It just sits between you and every merchant on the planet and takes a small cut of everything. That company is Mastercard, and it might be one of the most quietly powerful business models ever invented. Think about it this way. Every time someone taps a card at a coffee shop in Prague, or pays for a hotel in Tokyo, or shops online from Buenos Aires, Mastercard is there. Invisible, silent, getting paid. It's the toll road of the global economy. Once you own the road, you don't need to worry about who's driving on it. The business model is almost unfairly elegant. Mastercard doesn't own the money moving through its network. It doesn't take on losses when customers default. It just processes the transaction and charges a fraction of a percent for doing so. Multiply that fraction by over 150 billion transactions per year, and you get one of the most profitable companies on earth. Revenue last year, nearly $33 billion, growing at over 16% year on year. Net profit margin, above 50%. Let that sink in. More than half of every dollar in revenue turns into profit. That's not a tech company pretending to be profitable. That's a machine. Now, here's where it gets interesting. Most people think of Mastercard as a credit card company, but that's only the beginning of the story. The real growth engine? Value-added services, cybersecurity, fraud detection, data analytics, AI-powered targeting, identity verification, digital currency infrastructure. These services grew 22% last year, and they carry even higher margins than the core business. Mastercard is quietly transforming from a payments network into a financial intelligence platform. Let's talk about the AI angle. In February 2026, Mastercard and Santander completed the first live end-to-end payment using an AI agent in Europe. Not a demo, not a pilot, a real transaction. This matters more than it sounds. As AI agents begin managing more of our financial lives, booking travel, ordering supplies, paying bills, they'll need a trusted payment rail underneath them. Mastercard wants to be that rail, and they're investing heavily to make it happen. Now let's look at the numbers. Revenue, $32.8 billion over the past year. Operating margin, above 58%. Return on equity, forecast to reach 165% in 3 years. The company generated $3.6 billion in share buybacks in a single quarter alone, and raised its dividend. Again. For long-term investors, this is what compounding looks like in practice. Analysts are overwhelmingly bullish. Out of 53 Wall Street analysts covering the stock, not one has a sell rating. The average 12-month price target is around $655. The current price is around $500. That's roughly 30% upside, according to the people paid to know this best. Of course, no investment is without risk. The biggest near-term challenge? Europe. The European Payments Initiative, called Wero, is building a homegrown alternative to Visa and Mastercard. It already has 47 million users. Retail payments are going live in France and Belgium in 2026. This is a real structural challenge. European regulators want payment sovereignty, and they're funding the infrastructure to get it. But here's the other side of that story. Mastercard's response? Acquire the future. In 2026, Mastercard announced the acquisition of BVNK, a stablecoin infrastructure provider, for $1.8 billion. While Europe builds Wero, Mastercard is buying the next generation of payment rails. That's not a company standing still. That's a company that understands the game is changing and is paying to stay ahead. There's also the macro environment. Inflation, geopolitical tension, rising energy prices. All of this weighs on consumer confidence. But here's the paradox. Inflation actually helps Mastercard in one way. When prices are higher, every transaction is worth more in dollar terms. And Mastercard takes a percentage of every transaction. Higher prices, same cut. More revenue. The math works in their favor. And in a world where digital payments keep replacing cash, Mastercard's long runway gets even longer. Today, only around 30% of global transactions are digital. That number is heading toward 50, then 60, then higher. Every percentage point of that shift is new revenue for Mastercard, without building a single new product. So where does this leave us? Mastercard is not the most exciting AI stock. It won't double overnight. It won't make headlines the way Nvidia does. But it's built something much harder to replicate, a global monopoly on trust. Every bank, every merchant, every government has built their payment infrastructure around Mastercard. Switching that out is not a product decision. It's a decade-long engineering project. That's not a moat, that's a fortress. In a world of uncertainty, where geopolitics shake markets every week, and AI is disrupting every business model in sight, Mastercard keeps getting paid. From every tap, every click, every transaction. Quietly, reliably, everywhere. That might be the most powerful story in investing today.